vision, watch investors collide.
Hey, everybody. Welcome to another episode of Fundraising, a podcast where we interview early stage investors to get all the tips, tricks, tidbits, anything that you need as a fundraising founder to hopefully make your fundraising process that much easier. And today I have a very special guest, Kirby, the founding general partner of Ascend, an early stage venture fund out of Seattle, where he lives. And we were just talking about earlier, is also a hotbed for engineering talent, which we will definitely jump into here as well. But Kirby, thank you for being on. Can we start with a little background on the fund itself, including what you're investing in, average check size, and then we'll go from there.
Yeah, absolutely. Matt, thanks for having me on. I'm super stoked for this. I've been a fan, so pleased to finally make it here. So Ascend is an inception stage venture capital fund backing what we call unusual founders with unpopular ideas. And I'll get into kind of maybe what that means. But, just for brass tacks for founders, since I was a founder myself, venture backed twice, you really only care about a couple things. One is $500K check. We will lead. We also will catalyze around with the folks that we like to invest alongside of the bigger checks like Felicis first round, 0.72, folks like that. And we invest, all over. We've got, certainly a big presence in Seattle, but also probably 20 deals in San Francisco Bay Area, probably 10 in New York. We're in Austin, we're in Boston. And probably equally importantly, we focus on enterprise AI and deep tech. And we can get into sort of why that is and how. But those are the basics.
I love that. I'm kind of curious on the, maybe as a quick tangent, what are your thoughts on the investor operator background versus the investor finance background? Those are the two that we kind of see here. Curious if from your operating background, having founded a company, is that a unique advantage that you would say for founders that are listening when they're looking at like a characteristic to index on? One of the questions they've been asking lately is whether they should be targeting investors that were founders before or that were maybe not founders before.
So I think it's critical to have someone who understands the 0 to 1 journey.
Mm-hmm.
And you can understand it if maybe you didn't live it as a founder, but if you were on the founding team or if you've been an inception stage VC for a decade and you've been, a high EQ, beloved, helpful investor to those companies over that decade, then maybe you've learned. But otherwise, we see it all the time. It's just dangerous to have capital from quants at pre-seed or seed. I always say, look, you don't want me underwriting growth. Like that's not, I don't have an MBA. I'm not an HBS guy. Like, I was an English major. I was going to write the grand novel. And then I tripped and stumbled into startups for, 20 years. And we did 4 of them and 2 went public. And then the 2 I ran and sold, we raised venture for, and all that, which is to say, like, again, I'm not, there's a reason I don't do, I'm not running a long short hedge fund. I think I'm purpose built and people like me are purpose built for that first check. And that's kind of what we see founders resonate with.
I like that. And it kind of gives a little background on what you were doing before becoming a VC as well, which is great. We see back and forth on, whether or not founders should work with the traditional VC, because I think you mentioned this, and you can have both certainly after a while. But when you have the pattern reps of longtime VC and finance, the advice and context that you can give to founders is valuable. But I don't think that anything replaces the founder empathy that you get, obviously, from having lived through it yourself.
Yeah. I always say, like, look, we're in a deal where we were the first check alongside Vinod Khosla, and the founder goes, "Look, you're the guy I call when I don't want to call Vinod." And turns out, replace Vinod with any other, sort of blue chip multi-stage VC. The answer all the way up almost is that most of the things that you need to talk about, you're not going to talk to that VC about. And so you want to find a partner who, has the horsepower and the experience and the capacity and the sort of empathy to have those conversations, and the backbone to tell you what you may not want to hear, so that you're not, burning cycles with the person who might lead your next round.
Yep. Absolutely right. I agree. One of the questions that is one of the more favorite ones here from founders is, what is your favorite part about the job and being a VC? And then what is your least favorite part?
Man, there's so many favorite parts.
We're lucky. We're lucky we get to do this.
Yeah, yeah. If you asked me as a founder, I would have said I have one favorite part. It's when we exit. No,
Yeah.
as a VC, I think my favorite part of the job is when you're in a meeting with a founder for the first time and you just click over to pitch mode. So I don't, you probably have felt this feeling where you're like, you
Oh,
go
yeah.
into a meeting and sometimes you don't even want to take the meeting based on the, based on the merits. And you might be having a rough day. You might not be excited. And you go in and you're like, okay, now I got to put my gear on. I got to be helpful. Because my goal with every meeting with a founder is I want to leave them with one thing that they come back 2 years from now. If we don't give them money, they go, dude, when you told me that, that really changed how I thought about things and really helped. That's my goal in every founder meeting. So you got to have energy for it, but you don't expect every time, of course, or even that often at all, to be 10 minutes into the meeting and all of a sudden cut them off and go, okay, let me tell you more about how we work with founders, how we support founders. Let me give you some examples of places where we've kind of catalyzed, blue chip series A, seed, and beyond, and where we've, helped you hire your CFO or your founding engineer. And I love that feeling because then you get off the call and you're like, okay, who do I know that knows this founder who can back channel? Like, how quickly can I get confident about their capability? Because it's not like I've learned, like I missed some great deals by over diligencing at the inception stage. Like it's not about me getting smart about networking or chip design. It's about me getting smart about the person who needs to be smart about that. But that whole feeling of like, oh my God, we got to go. Like we got to pull out all the stops. Like we're chasing this down. That is my favorite part of the job.
Yeah. I'm going to put a bookmark in that too, because we'll talk about what triggers that in those meetings later on here. What is your least favorite part about the job?
I wouldn't say it's my least favorite because I don't mind fundraising and I like our investors a lot and I learn from them. But every day, week, month that I'm raising money is a day, week, month I'm not helping our companies. So I'd say that's maybe not my least favorite, but like the most unfortunate part of the job. I think my least favorite part of the job is seeing it's not seeing founders. It's not seeing companies fail because I need them to not fail, because we, as you probably do too, right? We underwrite to a way more than 50% failure rate. But because I've been a founder who actually sold companies and still felt like a failure, and seeing people just, especially after they've raised a decent amount of money or they've kind of been hot for a minute, or they've just been true believers and they just stall out and they can't make the journey. That is my least favorite part, is seeing the sort of human fallout of this industry, because it's real. I mean, people, for every person who sacrifices their well-being and their family life and ends up you know making a bunch of money or making a dent in the world, there are thousands of people who make those same sacrifices and get zeroed out. And it just sucks.
The human element of seeing so many companies and founders give everything that they have to come up short, even if that means that they sold the company or succeeded, it didn't quite hit the goals that they had, is it can be heartbreaking. And to your point, it is more often than not. It is
Yeah.
more than half the time.
Yeah. Yeah. Right. When you get into this job, you're going to have a lot of those conversations. And what you hope is that, what does Josh Wolf always say? Chips on shoulders, put chips in pockets. And we've backed companies, founders that have failed in our portfolio for their second go rounds. And, you know, that it's not always the last dance.
Yep, agreed. You mentioned earlier you're investing in, what was it, enterprise AI in deep tech. Is that right?
Yeah.
What are some of the areas specifically within those fields that are getting you excited right now, and or why are those the areas that you're kind of thinking about at a high level?
So at a high level, I mean, look, the first startup I was with, there were 5 of us and we built a portal and we used semantic web search. And so that was AI in 1996. The second startup that we ended up starting and taking out was used rudimentary machine learning to, append metadata to 200,000 websites that we own and then dynamically call ads and content to those sites. And then I did a big data analytics startup. And then so I've always been doing AI, and I helped, Paul Allen launch his incubator at the Allen Institute for Artificial Intelligence.
Awesome.
and sat there
You were way ahead of the curve. Yeah.
Out there for 2 years, seeing the pre-GPT wave of talent and technology, and got conviction around investing in it. So I started a fund in 2019 behind that thesis. And I think what we started to see was this. So post-GPT, the fidelity of physical world data and sensors, and the ability for AI to then take that data and create novel applications has just like skyrocketed. And so seeing that coming down the pike, we invested in Overland AI, which is, I think one of the top 10 defense tech companies in the United States now. And we did the pre-seed, and we did it when nobody was investing in defense tech. And we did it when it was sketchy for me as an AI software investor to think about investing in something that had hardware and sensors in it. And now, of course, they're building vehicles that, carry payloads to the front line of the battle theater. And I didn't think I'd be investing in that. So I guess, one thing is just like from a where's the puck going perspective, like it became more and more clear that these software hardware hybrids were going to be, I think, more defensible maybe than some of the vertical stuff that we'd invested in 2019 and 20. And also that the capital existed to fund these things. Because I think, historically those were not always the most favorable sectors to place your bets on as a pre-seed investor. But now with American dynamism and, the sort of the 75% of the venture capital raised in the past year going to 5 funds, well, guess what? All 5 of those funds love these categories. And that's not to let the tail wag the dog, but it matters. And then from an AI perspective, I mean, again, I've kind of lived it forever. I view AI on the longer continuum. So I think the GPT is a moment, but the emergence of machine learning was a moment. So I have a friend, an LP, who's advised presidents on AI, and he always says, "Look, AI is just really, 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 really fast, cheap data processing, and it's more than that." But like, so I try not to get too caught up in what the particular flavor of technology, and maybe think more about like, where is the technology best applied? And, one of the framings, one of the things I like about AI today and deep tech as well is that you can still find founders and companies that are doing things that make you sick to your stomach because they're so hard, and because they're not obvious. Because I mean, we like it when we can't find other people to do deals with us when we get conviction. Like I'm like, because as it turns out, if everyone's excited about it, we all know this, right? It's probably because, that's the thing that's hot at Series B right now, but you're investing pre-seed. So you're investing, 4 years ahead of the B at least, maybe 3. And
These days, maybe 2. You
yeah,
never
yeah,
know.
yeah, right. I mean, we've seen it, right? But, uh, but I think in these categories, there's still so many hard problems to solve and so many sort of unseen opportunities, and certainly so many talented people attacking them. So that's not.
And I think we're going to see more and more of these unlocked over the next couple of years for sure.
Yeah, yeah. Did you ever read the 3 body problem?
But yeah. Yeah.
So it's like I always think about AI or technology writ large as sort of a SOFON
Mm,
unlock. Sorry, and it's just this idea of there will be a moment where energy becomes ubiquitous and cheap, if not free, where disease is entirely curable or preventable. Where like I just believe those things will happen on a long enough timeline, and it might not even be that long.
yeah. I think within our lifetime.
Yeah, I mean I agree. Now, can we keep society together until those things happen? That's probably the harder challenge, which is crazy to think of. But anyway, sorry, we're
Nope.
drifting on.
No, no, it's all good. It's good conversation. Last question here before we go into the fundraising process itself. A little time for you to shine here. Why should founders want you and or Ascend on their cap table, especially in these early stages?
Yeah, I mean, I think it's hard because I'm kind of intellectually honest to a fault, and so I think a lot of folks will say the same things. We've helped people land their founding talent, their first engineering hire, whatever. We've connected people with their seed lead, their Series A lead. We serve as the sort of consigliere of the dark nights of the soul that founders have because I've been there. But I think honestly, if if you're the kind of founder who finds my approach to our relationship to be sort of it's vibes. Like, look, if you don't think I bring value in the first meeting, like, then you probably shouldn't take my money. Or if you don't walk away from the first meeting going, I want to talk to him again, then you probably shouldn't take my money. Like, but my bet is, and then if you were to ask around, the market, or, certainly our founders, the ones who have, raised hundreds of millions of dollars, and the ones who have failed, like, I think they would tell you they're happy they took our money, and that we've been the most helpful, active member of the pre-seed cap table on almost every one of those deals, if not every one of those deals. So I guess I would say, take our money because social proof, because I think increasingly we're a strong signal to the market. Our companies are backed by Founders Fund and Khosla and Lightspeed and Menlo and 8VC and the folks that you'd want to work with. But we're really just take our money because you think you want to work with me,
Yep. Sometimes at the end of the day, that's what matters most.
right?
Yep. It's a long game. We talked about this a lot on the show, where it's a lot of vibes based. It's, especially at the early stage, there's a lot of vibes based for sure.
Well, you got it. I talked to another investor. He said something interesting, which is like, you got to just want to talk to this person. When you invest in a founder, you have to want to take their call. It just isn't going to, like, and the later you go in the capital stack, the less that matters, right? It really doesn't matter almost at all past series B or C. But at the earliest stage, because you're going to be in there. I mean, if you care about founders and you care about your reputation, which you have to in our business because it's all you have, so you don't have money to do anything with, you go, well, I'm going to work my ass off for this guy or this gal. And for me to do that, for me to answer the bell every time, I need to believe in them, and I need to like them, and I need to want to spend time with them. And so, I think founders need to think the same way.
Agreed. All right, Kirby, let's jump into the fundraising process itself. We break it up into three parts on the show. The first is getting in the room. A lot of founders listening may not have the Rolodex or the email list or the contacts to just jump right into an inbox for a VC. So getting in the room, getting in front of a VC is very important. One of the things, though, that we want to talk about before that is, do you have any feedback for founders as they're thinking about who even to reach out to? A lot of times founders will just go to some sort of list, almost like VC sheet, and just look at the top names, all the ones they recognize, the Andreessen, Sequoia, Founder Fund of the world, and they just put them at the top of the list and they just start email blasting. But I found that the best founders can go a little bit deeper and characterize the right people to reach out to. Any advice that you'd give founders as they're trying to think about who they should reach out to in the beginning?
I mean, my advice would be to reach out to figure out which VCs you have a warm connection to and reach out to them. Like, I think at the beginning that matters way more than like any sort of programmatic outreach, which I hate and highly recommend you don't do, but which we can get into why. But like, initially, you just need to train yourself on what it looks like to get the intro to the VC, and then how you carry that intro to a call, to a follow-up, and like, what is a conversation with a VC? I mean, if you're really starting from scratch, what is it like to talk to an investor? Because I'll never forget, as a founder, the first time I walked into a meeting with the investors, some investors that I knew, one that I knew in particular, I was like, we were bootstrapping, and I was like, this is just a friendly meeting. And it was on a Monday, and it was on Sand Hill Road. And I walked in, and it turned out it was a partner meeting.
Oh, wow.
And he, my friend had told his partners, like, hey, these guys have done, startups before. I'm like, they're doing a new thing. And I was like, yeah, I don't know if we're going to raise venture. So clearly we did, and didn't raise it from them because I didn't have the right, like, so I think just learning, like, what does that feel like? What is, and because the other thing is, it's so different telling a story to a VC versus a customer. And all you've been doing is talking to customers, and you're so proud of all the things you have and the features and how smart you are. And you're going to try to tell the VC all that stuff, and they're just going to puke because
Yeah.
they just want you to make it simple. They need to remember one thing about your stupid meeting, like, stop with, right. And you just won't know that until you do that enough. So that's a really long-winded way of saying back into it by, like, just anyone you have warm connections to. Talk to angels if they're, like, serious angels. But really, there's no way to replicate like a venture mindset. So I think that's critical.
Yeah, just getting the reps in, getting in front of as many VCs as you can. And the other thing I wanted to call out that you mentioned from earlier is it is almost more important to get the warm intro than the cold outreach to the perfect investor. And the reason why is that oftentimes what'll happen is if you get the warm introduction to an investor, even if they're not interested in what you're investing in, that person, that investor probably has a network of other investors where something might come to mind for them. So if you get a warm introduction to an investor, they could very easily take the meeting themselves and or top of mind go, I know somebody who would be interested in this. And then they'll forward it along, which is, it's a warm intro from a warm intro, but that still can be better than a cold outreach.
I think the thing that almost no founders know is if you meet a VC and they are impressed with you,
Hmm.
maybe they can't invest for whatever reason, but they're impressed like wow, they look good introducing you to their friends and the people that they want to impress. Like your job is to, in any meeting with any investor, have them walk away going, holy shit, like that that woman is backable. Like that woman is smart. That woman is going to make me look like I've got the best deal flow in the world when I share this intro. That's why you just got to get in front of investors.
Yeah. And it's one of those things that you just get better at with every single meeting and every introduction. So the more that you can do high volume, the better for sure. Let's talk a little bit about the process of pitch decks is maybe the right way, but even before then, I like to call them blurbs. I think blurbs are one of the most underrated things that you can do kind of during this phase, even with a warm introduction. Because you mentioned earlier, investors just want to be told specifically and succinctly and not in 1,000 words what it is that you're doing, why it's worth their time, all these different things. What are you looking for in that blurb or that, the one liner, one paragraph, the forwardable email, the piece before the pitch deck to get you excited to even dive into that pitch deck? What does a founder need to include in that?
I mean, shockingly, they need to lead with who they are and a hyperlink to their LinkedIn page.
Hmm.
It's
Left out a lot. Yeah.
phenomenal to me how few people. I mean, it's like, I mean, it might be half. I don't know. It's crazy. We're investing in you.
Yeah.
So, and you don't
What do
need
you say to the Gen Z people out there though that maybe don't have a LinkedIn account and they're thinking, well, do people even use LinkedIn anymore?
My son is 19 and him and every single one of his college classmates and high school friends all have LinkedIn pages. So, I mean,
It's feedback I've gotten before where they're like, oh, LinkedIn. I just didn't think that was something that people used. And I'm like, yes, your investors use it.
yeah, yeah. I think it's more likely that you will be converted to LinkedIn than you will
The next.
convert us all to some other method of finding out who you are and what you did. Of course, if you're special, then you're special, and I'll go to your,
Mhm.
I'll go to your GitHub,
No. And to that point, though, that means that you should also spend the time to make sure that your LinkedIn profile is also not just an afterthought either.
I mean, I saw this the other day with a guy that I actually wrote a term sheet to, and I was like, before we go out and share this with other investors, like you got to update your LinkedIn. 'Cause it just because the vast majority of us, the first thing we do is we go to the LinkedIn and we take a snapshot, and a lot of times that snapshot. I mean, I'll tell you that again in the context of what's the blurb. I don't know what the blurb is. But most of us aren't reading the blurb. Like we don't get to the blurb.
Yeah.
At this point, I don't even have time for your blurb. I don't
So you're going to their LinkedIn first before you even read anything else. Yeah.
because I need to figure out if you're credible, and everyone's definition of that is going to be different. But your background and work history are good indicators of credibility.
Yeah.
And I think
There's no faster way to just get a snapshot of that.
you get a snapshot, and you almost never hard pass on that, but it sets it up for then the rest of the blurb, which, may or may not have to be less or more convincing based on what your profile is. I always say like there's three things that matter. It's, what team, technology, and traction. And the more you have of one, the less you need of the others. So if I go to your LinkedIn and it turns out you're Steve Jobs, part two, then okay, I don't care anything else. If you're not, then I have to look at, okay, well, what are you chasing? what's your vision of the world 10 years from now? Like, why is it unusual and audacious? And if what you're saying you're going to do about it to effectuate it works, like, does it matter? That's the question that I want to answer. And then at pre-seed, I don't even want to hear about your traction. Like,
Yeah.
if
Yeah.
you got if you
Agreed.
got if you got a pilot, great. It's almost for pre-seed investors. I don't know how you feel, Matt, but like I'm like, if they have a little revenue, I'm almost like, because now you've started the journey and maybe you have a bad customer or bad customers, and like I really want to be there before that happens.
Yeah.
Well, we can talk about it, and I can help you kind of think about shaping it. I've just learned, the further it gets towards seed, like the less likely I'm going to see an outlier deal.
Yeah.
You know what I'm saying? Like
Yeah.
we gotta, like, again, I'll speak for myself. I gotta be betting while you're still at your existing job. You know, I gotta be betting before you've got your deck. Like I've got to be betting so early, because if you're right, then you're not going to talk to me 6 months from now. And so that means that if you are talking to me 6 months from now, it's negative signal. Like if you've got 200K in revenue, I'm like, okay, if you started a year and a half ago, I'm like, well, why are we talking? Like, and that's been a weird learning in this job, actually, because I think it's intellectually, like, it's not what you would initially think. You would think, oh, more
Mhm.
traction, de-risked. Well, I don't care about being de-risked. I care about opportunity for exponential upside. And if you're
Mhm.
showing me that you don't have it, the longer that you've been showing me you don't have it, like the less likely it is you're going to get it. This is also something that founders do not understand about venture. The clock starts, and yeah.
Yeah.
So
Yeah, I like to talk to all of our founders. It's velocity and momentum, and you need to be able to show both of those things. Where if you, to your point, if you show 200,000 in revenue and it's a year and a half, that's very different than even 100,000 in revenue or 50,000 in revenue in 2 weeks. Like we'll take the shorter timeline than that. And even then, whenever I've met founders that are like, we've been doing this for 3 years, and over the last 3 years, we've gotten 1 million in revenue. It's like, well, that's a long time. And again, it's like, well, why now? But then you dig deep and you're like, oh, but that million came within the last like 2 months. You guys started 2 months ago. Like, let's
that's
let's
no,
change the
oh,
narrative
I
here.
love that. I love that, dude. Yeah, I love it. I love it because also the mistake people make. Well, now we're going to go off to something else, but like they raise money and then they go, we got to grow. We need revenue, and I'm like, no. You need to get ready to make a lot of money in a short period of time. Like nobody cares what you do after your raise. You get a 6 to 12 months grace period. As long as the 4 months before your next raise, you're going from 1 unit to 3 units to 6 units to 12 units to 20 units.
Yep. Yep.
And
You need that velocity.
yeah,
Yep.
yeah, you're totally right.
Yep. Yeah. Really quickly on pitch decks. You've already given some good examples of the things that you're looking for, whether it's in the blurb or the pitch deck. Any high level advice on just the pitch deck itself? Maybe less about what to include, although you can add that in there, but maybe how it's presented or any other mistakes or common mistakes that you see with pitch decks.
That's a hard one because some of the best companies have the worst decks.
I know.
So,
That's true.
so it's sort of, I think the pitch deck question is a lot like the investor update question.
Yeah.
You can find data that, there's correlation and there's some correlation and potentially no causation. Like, so whether you send updates or not, like I prefer you do because it makes my job easier, but it's not going to make your company different unless you're preternaturally like disorganized or whatever, in which case the discipline helps. When it comes to pitch decks, what I will say is like, just don't, it's almost like what not to do. Don't get creative with the structure. Don't have more than 12 slides. Do have the 12 slides that DocSend says you should have based on their billions and billions of decks worth of data. Know that investors spend an average of 20 to 30 seconds on your deck. Know that if you do get to present it in a partner meeting, because you're certainly not going to present it on a call that often, you might if that's your style, but we don't like
Yeah.
it, right? So,
Yeah.
so it's kind of a leave behind. It's kind of, now it should, to the extent that it guides or reflects your narrative, it's very important. Like, so I would say there's the pitch deck, the physical artifact, which, just follow the rules and make it look good. And, I don't know, there's whatever. I found that people can only make the pitch deck that they can make.
Mm,
I was like a B minus deck maker.
there you go.
Like
Because if it's too good, sometimes you're like, no, something's wrong here.
sometimes when you get a pre-seed deck that looks like a, IPO, pre-IPO roadshow deck, there's, but, but, but I think the things that you do need to remember, again, your job is to leave the recipient of your deck with one idea, which is like, these are the people, these are the right people to do this thing, and this thing matters. And this thing is X. It's a marketplace for pet owners and caregivers. It's a verification platform for generative AI. It's again shocking how few people realize that not only do they have to be clear about that at the very beginning of the deck, or else you lose people for the whole pitch. You need to say what you're doing, and you need to have a logical progression. But that's the whole point. And that's all you're supposed to do. It's not the goal. The goal is to get another meeting.
Exactly. Yep. Let's talk about the meeting itself, because that's an important part. We kind of call that the phase two here. So you've impressed them enough to get that 30 minutes of time. You mentioned earlier, one of the things that you love the most is when you have that moment in that meeting where all of a sudden you go, I need to invest in this founder. I'm excited to invest in this founder. You start going into pitch mode yourself. What does it take, or what is it that makes that click for you during those meetings to get you excited?
I mean, if I could answer that question, super accurately, I'd probably, I'd, if I, so the answer is, I don't know. There's sometimes it's like a subtle indicator, and I'll be willing to admit that I may have been played once or twice, right? Because if you're a good poker player as a founder, you can kind of, there are things you can do, but you got to be real careful because it can be corny and obvious. And also you kind of have to have the cards. But, when I hear like, if it's someone I already like, I'm excited about, but then I also hear like, we've been talking to investors for like the last week, and, it feels like, um, it feels like we'll be wrapping this up in a week. Like, that's something that sort of piques you a little bit.
I think that what I was going to add on top of that is that, to your point, it's hard to build the checklist of like what you need to get excited because it's different every time. But you mentioned earlier something that I think is important is you mentioned the what was it, the three T's with team, traction. What was one of the other T's?
Technology, which is just
Technology.
teamwork.
Yeah, almost the idea
Yeah.
of like what you're
Yeah.
building. And you're exactly right that sometimes if you have one of those things that is, top percentile, the other ones don't matter as much. And it might be in this case that that person's background or that person's team or just the way that they're going about it is so good that you get excited to invest. One question maybe to add on top of that, maybe as a replacement question is, do you ever see it where does one of those things need to spike? Or if all of those things were just good, like B plus, is that enough? I guess, do you
Yeah.
need an
Oh,
A plus with one of
that's a
those?
great
Or
question.
yeah,
Yeah. 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 So I was thinking about this recently, and I realized, yeah, no, one of them needs to spike. You have to be, and it's so painful. This job is so painful because you just have to learn through, reps. And it's like, I think my first fund, which I love the founders we backed, and we've had a lot of successful companies in that fund. But if I look at on the whole, like, I backed a lot of folks and teams and companies that, yeah, they were, pretty damn good
they were good.
on
Yeah.
all of those fronts.
And this was Jake Storm at Felicis was the one that introduced me because they use the term spikes. He's like, we look for spikes.
Yeah. Yeah, it matters much more that you're really, really, really good at one thing and I'm an example of this as a founder. Like, I was very good at most things, and I was not insanely good at anything. Like, and which is great if you're like on the founding team, or if, if you're a GM, or if you're running a P&L, or, like, there's all sorts of jobs that I was suited for, being a VC, where I don't think you need to be quite as spiky, but I was not, I didn't have it. And that's why, we sold companies and they were fine, but we were never going to go parabolic, no matter how good my technical team and co-founders were, which is kind of, I did them a disservice. But yeah, and it's also that thing, you go, yeah, you just get more comfortable as you go in this job, investing in spiky folks. That's really well said.
Yeah. Yeah. Are there any mistakes that you see founders make during some of those intro calls where you're maybe meeting them for the first time?
I mean, never have another person on the call. Never have like an introducer on the call or an advisor.
Oh, yeah.
If
Yeah.
someone introduced you, and that person thinks they should be on the call, just no. That's it. It's the death knell. You can't do it. So it's got to be you. And if it's to you and your co-founder, have a reason for your co-founder to be there. Like if they're just
Yeah.
sitting there,
Tag team it. Yeah.
yeah, if they're sitting there watching the show, it's
Or answering emails on the side.
yeah, it's a net negative, and also
Yeah.
shows me that you're not valuing, your time. Like you're not valuing your time or their time.
Hmm.
So it's a negative signal. What other mistakes do people make? Going into your pitch deck without asking,
Yeah. Just reading through it. Yeah.
or without asking if the investor wants you to. Like, I mean, I'd much, much, much rather just have a conversation with you about who you are and why you're doing what you're doing. Like, it's not a test, and your pitch deck isn't going to help you pass the test.
Yeah.
Like,
Do you think it's one of the things that founders ask? One of the questions that we have is, should founders ask the questions up front to say, what are you looking for in this meeting? What can I explain to you that maybe you didn't see in the pitch deck? Are those types of things that you'd recommend founders kind of lead with as they're going into it?
I think this is very subjective,
Hmm.
investor by investor. My thing is, if you are anything that smells like over baking it is a red flag or a yellow flag for an investor.
Hmm.
Like you should be really, really busy doing important stuff. And yeah, you have a deck. The deck, you made the deck, and the deck's like, okay, investor, you want to see a deck? I got a deck. Like you kind of have to be like, you're on even ground with the investor. Like I know it doesn't feel like it, but and you don't. I hate when you can't get people get coached to be like too brash and interview you as an investor. Like you ask me the
Yeah.
questions, it's fine, but like
Don't be arrogant. Yeah.
I don't be arrogant, but also like way too many people are limping in, and it's like, look, no, don't ask, don't walk in and be ready. Like walk in and assume that you're going to have a conversation about something that you know better than anyone on the planet, and you're pumped to educate someone and share that with someone. That's all. And if that person needs you to walk through a deck, be ready to walk through a deck. But and if I think it's good practice to assume not, and ask at the outset, like, you want me to walk you through a deck today, or should we just have a conversation? And because the conversation is where we get excited. That's where we find out
Exactly.
you're the person. We're not backing decks. Like
I've never been excited to invest after a founder reads through a deck, not once.
right? And I think I also mistake being too precious with your deck. Send it ahead of
Yeah.
time if you're asked to send
Yeah.
it ahead of time. Send it ahead of time if you're not asked, because then I can scan it
Definitely.
2 minutes before our call, and I'll be smarter. I'll be ready. You know, investors are not spending 20 minutes preparing for your intro call, and a good deck gets me there fast. So yeah, when it's not there, you're only disadvantaging yourself. Nobody's going to steal your idea. Nobody's like, maybe series B, like again, when scale up competitors, all that. But like early on,
Yeah. No, I agree. What are some of the mistakes that you see founders make as they're closing up? So, one of the benefits of being an early stage investor is that you are typically there first or early, and then you get to watch them close out the round. So, I find that these investors typically have a good wisdom around the right way and wrong way of finishing out that round. What are some of the mistakes, or it could put in a different way? What should founders be aiming for when building out their cap table?
oof, I mean, that's a big question. I I think a mistake founders make in general when they're raising rounds is they don't have enough VCs on their hit list. Like they don't stuff the pipeline. They get optimistic. So I think when I've seen people struggle, I can't remember the last time we had a founder that we were first checked into that didn't close the round. But or we come oversubscribed even. But like when we've seen people struggle, it's when they think it's like, okay, well, Kirby's in, and then we've got two other 500K checks. We got $1 million check that we've been talking to. We think they're probably in, so we're not going to start any new conversations. And it's like, well, did they wire the money or they sign the docs? Because until that happens, go and talk to everyone that you think would be awesome. And it
Exactly.
doesn't hurt because they could always come in later or they could get excited and oversubscribe. There's no downside to talking to more investors, except it takes your time, but that's the job. And so I think that's a mistake we're seeing. I think something that I've seen people do that I like is tranching. And
Hmm.
and so especially if
It's like closing. So that's the idea of closing kind of as you go. Yeah.
yeah, because here's the thing, like, and nobody's gonna feel bad for me. They never feel bad for us, right? But like, I don't think I've ever asked a founder at the pre-seed when we're committing to invest who else is investing. I just don't care. But because of that, I'm taking the most risk of anyone on the cap table. So like, give me, if you're concerned, if you want the valuation of your round to be 18 post or 20 post, okay, get us in at 12 post and close a tranche at 18 and close one at 28. Like, and that's a great catalyst because founders are always like, well, how do I get people to close? Like, well, tell them that this tranche is closing. That aside from having a term sheet from like a tier one, tranching is probably the single most effective way to get people to sign the docs. Like it's great. And the thing is you just take where you want to be, subtract 3, that's the first tranche, add 3, that's the second tranche. And you raise half your round overnight and like I don't know why more people don't do it.
I think it's because I did that when I was raising. I think the downside there, which you don't really, maybe it's a good problem to have, but you do end up getting cranky investors as you go through because you will have investors that are, as long as there's maybe flexibility as a founder. But if you're meeting with an investor and it's like, oh, last week this person wrote a check at this value, well, I want that valuation, and so
Yeah, but
you'll
I
have,
would I would say that's not a sophisticated investor.
yeah,
Like
yeah. I
like,
mean, it's true.
I mean, you know what? Like, I'm like, we just did a deal actually where someone else had committed before us, which almost does not happen that often, but we really like the founder and we paid 25% higher than the person who had committed before us. And I didn't ask whether that was a week or 2 weeks ago. It doesn't matter to me. Like, fair is fair. That I should have spent 4 months with the founder. I didn't. Like, and by the way, when Matt writes a check, by virtue of that, the company is worth more money because
Yeah,
you've now put your
it's true.
name on it. You've done the diligence. Like they can look at your portfolio. Other investors can look at your portfolio and feel de-risked. Like, so I think the time thing is a total fiction.
Yeah, I like that. All right, maybe last question here because we're butting up on time. What a lot of times we see founders they think about the fundraise, but after the fundraise is when the work really begins, and a lot of times founders stumble a little bit after because there's almost a change shift. Their like mental model has to change almost immediately. What is some advice and or maybe some mistakes or pitfalls that you see founders make immediately after they close the round and maybe for the first few months after?
I mean, like I said, I think one is just getting obsessed with revenue and closing customers at sort of all costs. And this is all pre-seed advice. So obviously,
Of course.
sure.
Yeah, first check.
Yeah.
First round is just closed, yeah.
Yeah. I mean, I think people also make the mistake of feeling like they need to hire a team in air quotes versus like add the most insanely talented people they can possibly find and take their time to do that. Like just build and do customer development. You can do customer development when you don't have a product. Like do customer development, hire a sick team. And that if those are the only two things you do for 6 months, you're going to be in great shape in month 7. I mean, so I just think people get it twisted and they feel, especially first time founders. And I've done this, you're like, well, I have the money. I guess I got to hire a marketing associate and a customer success person. I'm like, you didn't even have a customer, you know,
Yeah.
you're hiring a marketing person.
Gotta hire HR to then manage the people
Oh,
that
it's
I
the
don't have yet.
worst. Yeah, it's the worst. And I mean, we've even like unless it's a co-founder, I don't want you hiring a CTO. Like, there's just a lot of that stuff. I think are pretty common mistakes for folks who are doing it the first time and haven't been around great. Like, I think it's such an advantage. And people always like, oh, well, why do VCs always just want to back like people that were at a successful startup early? Like, what does that have to do? They got lucky. I'm like, well, yeah, they got lucky, but they got lucky to see what great looks like. Like, that's how if you're not like, what are the odds that you stumble on that yourself? Yeah. But if you were at SpaceX, for the development of Starship and you worked on a project directly, like, yeah, I think I'm gonna be excited to back you and your team out of SpaceX.
it makes a difference. Knowing and seeing what success is, even if you were a smaller part in that success, it carries over. It definitely does as a founder. Kirby, this was awesome. We covered a lot in a little bit of time here, and we could have gone on for at least another hour, I think, as well. Thank you so much for being on. Where can folks continue to follow along with you and the fund?
I am on a Twitter hiatus, which it's self-enforced. No, nobody
Good. That's healthy.
nobody else made me do it. But yeah, I'm on LinkedIn, Kirby Winfield, and our website is ascend.vc. And if you want to see the reason that I quit Twitter, you can go to @KirbyWinfield.
Oh boy.
No.
Now I'm gonna have to.
Years and years of compounding rants and
There you go.
good stuff. But anyway, yeah. And I'm just Kirby@ascend.vc is my email if anyone wants to hit me up. Happy to.
There you go.
Yeah,
Warm intro preferred though.
for sure. But asynchronous email responses will be delivered.
There you go.
Fine doing that.
Perfect. Well, Kirby, thank you again. I'm excited to maybe chat again soon. We shared before this that we have some Colorado connections,
That's
which
right.
is always good. So hopefully maybe next time we'll do this in person.
It's been a blast. Thanks so much.
Absolutely.
You could tell I get a little overexcited. I love this stuff. So hopefully I didn't jump through the screen on you, but
No.
this was really fun.
No, definitely not. No. Awesome. Thank you again. Let's chat again soon.
Sounds good.
Bye.
Bye-bye.
Pitch pass, iterated fast. Story beats data when the storyline's fast. Vision's the ignition, but the numbers steer the ride. Conviction and precision, watch investors collide.